Hi everyone. Today I'm gonna discuss about the two Modigliani and the Miller's proposition and the key assumption underlining them, and their relevance to the capital structure discussion. At the introduction in 1950s, the Modigliani and the Miller presented as a theory of capital structure of the businesses. The Modi Galini and the Miller approach the capital theory, deserved in 1950s, advocate the capital structure irrelevancy theory. They suggest that the valuation of the firm is irrelevant to the capital structure of the company. Rather, the market value of the firm is solely dependent on the operating profit of the company. The second is the value of the business depend on their ability to generate a profit. According to the Modigliani and Miller theorem states that the market value company is correctly calculated as the presented value of its of its future earning and its underlying assets, and that and it and is dependent of its capital structure at its most basic level. And the theorem argue that the certain assumption in the place, it is irrelevant whether a company finance its a growth by borrowing and borrowing by issuing the stock share, uh, or by reinvesting its profit. Composition of their capital structure does not matter. According to the Modigliani and Miller, according to the Modigliani and the Miller, if it is there's if there are no corporate taxes and the mix of debt and equity doesn't matter, and does not have any impact of the value on the value of the firm. The value of the firm is simply equal to operating income divided by the overall cost of the capital. And the fourth one is the distribution of the profit share of to the company shareholder, also not necessary. Modigliani and the Miller proposition without taxes. Uh, in the PowerPoint slide, it shows that there is no transaction cost, and shouldn't be a transaction cost, and no taxes and their effects. Investors have a full investors have a full access to the information of the business, and no cost of the liquidation, no importance of the dividend given by the shareholders. Uh, and at further, the extension of the taxes are beneficial for the businesses, and the saving of taxes on interest payments give benefit to the businesses. Lessen debt cost due to the tax shields. Higher the value of debt, lessen the overall WACC. Theory contradict the position, the proposition, the agency cost theory, packing order theory, and the trade off theory. Agency cost theory, asset substitution and free cash flow, debt overhanging issues. Uh, then the packing order theory, there are three of them. It's a retained earning. Second is the debt, and third is equity. Yeah, utilize the less costly finance source first. Trade-off theory is the project only and the higher return. Wealth of investors get maximized. dividend given unable investor to retain, and the more investments in the businesses, the capital structure composition of the debt and equity variables have impacts. At the end of there is the existence of taxes, liquidation cost, and there's in summary is symmetrical information and investment management, transaction cost existence, and these are the factors make the M&M proposition not suitable for a real world market. Thank you very much.